The global economy operates like a massive biological circulatory system. Its lifeblood is energy, specifically petroleum liquids and natural gas, in constant, fragile motion around the planet. But if that flow stops, everything stops. To find the heart of this system, you have to look here, the Persian Gulf. This small pocket of the globe includes Saudi Arabia, Iraq, the United Arab Emirates, Kuwait, and Iran. Combined, these nations pump out roughly 30% of all crude oil produced in the world. Because so much of the world's power generation originates in this exact spot, any localized military conflict or political instability instantly becomes a worldwide supply crisis. All of that energy has to leave the Gulf to reach global markets, and almost all of it exits through one single geographic doorway, the Strait of Hormuz. This chart shows the geography of the strait. It sits between Oman and Iran. While the waterway looks wide on a standard map, the actual deep water shipping lanes for massive tankers are highly restricted. They are only 2 miles wide in each direction, separated by a 2-mile buffer zone. Through that tiny 4-mile gap, producers push an average of 20 million barrels of oil every single day. That is roughly 20% of total global petroleum consumption squeezing through a maritime needle. And it is also the only route for major Gulf exporters to ship liquefied natural gas, or LNG. Over 110 billion cubic meters of LNG pass through here annually, representing nearly 20% of the entire global LNG trade. The 21st century global economy is bottlenecked by a single physical maritime choke point. When military tensions flare near the strait, the global markets do not wait for ships to physically stop moving. Futures traders immediately begin pricing in the probability of a disruption, creating what economists call a geopolitical risk premium. This chart shows the logistical friction of war. The cost to insure a commercial tanker in a conflict zone can spike 300% almost overnight. That fear feeds directly into core commodity prices, where Brent crude rapidly surged past $90 a barrel. Faced with these extreme costs and the physical danger of missiles or mines, shipping companies will often drop anchor or attempt to reroute entirely. That means millions of barrels are suddenly missing from the global market. Through these financial mechanisms, a localized exchange of gunfire in the Middle East instantly converts into an economic shockwave felt in Tokyo, London, and New York. The first ripple of this shockwave hits global freight. Rerouting ships adds thousands of miles to a journey, and burning more expensive fuel pushes shipping rates into the stratosphere. Next, it hits agriculture. Natural gas is a critical feedstock for creating ammonia, which is the base of commercial fertilizers. When Gulf gas gets trapped, global fertilizer prices explode. Expensive shipping and expensive fertilizer combine to drive up the cost of manufacturing and eventually the price of groceries on your local supermarket shelf. This is cost-push inflation. It happens when overall prices rise because the cost of production and raw materials increases. A disruption at the strait infects the baseline cost of everything humans consume. This chain reaction is a documented pattern that repeats whenever regional stability in the Gulf breaks down. During the 1973 Yom Kippur War, an Arab oil embargo triggered a 300% price increase. It caused massive global fuel shortages and forced rationing in the United States. In 1979, the Iranian Revolution abruptly removed 7% of the world's daily oil production. Within months, global oil prices had more than doubled, and the 1990 Gulf War severely damaged regional energy infrastructure, causing immediate market panic and another sharp spike in the cost of crude. The historical data shows a consistent correlation. In each of these cases, a major Middle Eastern supply disruption was followed by a global recession and a sharp increase in unemployment. This graph illustrates a specific, dangerous structural conflict: economic growth trending down while inflation spikes up. Economists call this stagflation. It traps central banks in an impossible scenario. If they lower interest rates to save economic growth, they make the inflation worse. If they raise rates to kill inflation, they push the economy deeper into a recession. A physical maritime blockade in the Middle East ultimately paralyzes the highest levels of global monetary policy. Our digital economy is often described in terms of weightless data and services. Yet it remains physically dependent on raw resource extraction. Every server, every supply chain, and every facet of modern society remains tethered to millions of barrels of physical liquid moving through a volatile geography. If a single regional war can sever this 2-mile-wide artery and instantly choke off the world's energy supply, how stable is the global economy really?